UK business owners, are you tired of handing over truckloads of cash to the tax man? What if I told you there was a legal way you can use to save thousands? Today, we're going to dive into the world of capital allowances, your secret weapon against sky-high taxes. Hello everyone, I am Fizan. I am an auditor, accountant turned entrepreneur. I am the founder of Innovative Consulting, where we help businesses grow, help them save taxes, save time, and help them be more efficient. Okay, so what exactly are capital allowances? They're like magic beans for your business. Think about this. Every pound you spend on your business to buy essential assets can be used to shrink your tax bill using capital allowances. It's like getting a discount for running your own business. Think of capital allowances as your best friend, be it upgrading your IT and tech or improving your workspace with new furniture and sofas. All of these investments can actually help you big time when it comes to tax season. So capital allowances cover a lot of things like computer, laptops, office furniture, desks, even your delivery van. If it's essential for your business, it's getting tax deducted. Now, when it comes to capital allowances, there's two types of pools that we deal with. One, we've got main pool, and then we've got the special pool. Let's talk about the main pool first. Every qualifying asset you buy, the cost of those assets, they get added to this pool. Now, think of it as a tax saving bucket. Each item you add in this bucket means you save more in your taxes. Now, when it comes to main pool, there's different types of relief options that we're going to cover today. First is annual investment allowance, or AIA. So in AIA, if you spend more than £1 million in a tax year, don't worry at all, because the excess gets added to the written down allowance, which means you get tax deductions by 18% of the pool cost year on year. Next is first year allowance. Do you want to go green and want to buy a zero CO2 emission car? Well, congrats, because you can deduct 100% of the cost from your taxable profits. Now, do you have assets from one of these pools that you use for both business and personal use? Well, don't worry at all, because you can still claim business portion of the allowance. It's like sharing a pie. You only get to pay for the slices you eat. Okay, so next is written down allowance, or WDA. So WDA is given at 18% of the costs of the assets in the main pool after taking into account of all the disposals during the year. So essentially, it's given to all unrelieved expenditure in the main pool during the year, or it's given to all the assets that are not qualified for annual investment allowance or the first year allowance. Now remember, when a business is being permanently discontinued, the first year allowance, the annual investment allowance, or the written down allowance is not available in the final period to the date of cessation. So after main pool, we've got special rate pool. So what's special rate pool? Well, special rate pool is a pool of qualifying assets that operate in the exact same way as the main pool. The only difference is the 6% written down allowance that's given instead of the 18% given in the main pool. So what's included in special rates pool? Well, long life assets like plants and machinery costing more than £100,000 with 25 years of expected useful life, or integral features or say structures of the buildings, thermal insulations, and last but not the least, high emission cars. They all qualify for a special rates pool. You must be thinking, what happens to VAT, right? So if a business is registered for VAT and is able to claim the VAT that is being charged on the purchase of qualifying assets, then the capital allowance calculation is done net of VAT. So the only exceptions are cars, where VAT can only be recovered if the car is used 100% for business purposes. That's it. Now next is structure and building allowance, or you can call it SBA. Now when a business incurs expenditure on qualifying costs for say new non-residential buildings or structures, or improvements and renovations to the existing non-residential structures, they become qualified for an SBA allowance of 3%, which is an annual straight line 3% allowance that's given to businesses year on year. Now remember, All assets that are part of SBAs are actually kept separate, and they're not part of any other pool like main pool, and therefore they're not given allowances like annual investment allowance or any other allowances that we discussed earlier. And they include stuff like roads, walls, office premises, buildings, warehouses, and stuff like that. And there you have it, capital allowances made easy. Use these tips and tricks to help you save on your taxes and invest in your business instead. So if you found this video helpful, hit that like button and subscribe to our channel for more tips and tricks on saving taxes and making your businesses more efficient. Until then, see you in the next one.